Well, this is day 2 of the attempted rally, and when I put it like this, it doesn't look all too wonderful, but when we look at it like this, all 11 sectors were up in the S&P 500, got some moves there in the index products. You look at the heat map, we got a lot of green on our screen, but the mega cap stocks are still kind of holding us back. It is day 2 of the attempted rally, and this is coming after the fastest 10% correction that we've seen in 75 years. On today's Stock Market Brief show, we're going to be diving into why day 2 is important and what to look for. We're going to hop into market conditions, where they stand. I got some extra charts in there, and the expected moves and some of the good structure we're seeing from a smaller time frame to be aware of. All that and more. Make sure to subscribe if you haven't done so already. Smash the thumbs up. That's greatly appreciated. Today's episode is brought to you by my partners, Interactive Brokers. So make sure to check them out. They got a free campus over here with tools, resources, training courses, you name it. And then my patrons for $9 a month, you can sign up and get access to the Discord, which has all types of benefits, including daily, weekly, monthly, quarterly expected moves. You get a comprehensive set of query bots that you can type in commands. This is all from Tradie Ticks, which is pretty cool service to get all kinds of cool stuff. Yeah, let's go ahead and get into today's show. All right, everybody, welcome back. We're starting off here looking at the chart of the S&P 500. And for the last few days or so, we've been videos or so, we've been preparing everyone to watch out for some sort of reflexive bounce. Things were getting oversold. This is what typically happens. Is this a bottom? Is this the bottom? That's to be seen still. And we're going to talk about what specifically that I'm looking at and get a little bit more intricate. It's based off of the research from William O'Neill, dating back way back when, right? There's a lot of research on what's called a follow-through day and these attempted rallies, but then I incorporate some of my own elements into it to be a little bit more tactical in the environment. Now, from a weekly perspective, we are disconnected now, going on week 2. It's early start to week 2. Disconnected from the weekly 5 EMA. This is a frequently tagged EMA, so it's likely to get back up here or to tag it, right? If we go sideways, for it to come down and tag it here in the very near future. But just be aware that we are currently disconnected from that. And it's likely when you get disconnected, you see snapbacks. Same thing if you get extended from it, you can see snapbacks too as well. Remember down over here in August, we snapped back pretty significantly up there. Okay, so let's take a look at SPY on the daily time frame. So what do I mean by day 2? Well, this was the low over here. It was a closing down day. And then we had a rally day 1 and a rally day 2. What we look for now is called a follow-through day, and this is day typically 4 through 7, right? You can technically, they can come earlier, but day 4 through 7 is a little bit better based off of the research through William O'Neill. And what a follow-through day is, it's a day that's up 1.25% or higher on a higher volume than the prior trading day. So if you want to follow along, make sure to be subscribed to the channel, or you can follow me on X. We'll be posting updates as we continue. So this right now is day 2, tomorrow's day 3. Now you might be thinking, well, what happens if we close below or have a down day? As long as this low is not breached, the attempted rally phase, R, we'll call it AR, attempted rally phase, is still intact. So day 3, say if we have a down day, whatever. Day 4, say we have a down day. Day 5, say we have a down day like this, but this low is still intact. And then all of a sudden, boom, we get a big follow-through day with higher volume than the X. That would be considered our follow-through day. Now, I'm going to show you an example of what this looks like. Now, everyone pretty much remembers the 2008 financial crisis for the most part, and just how much volatility was actually in it. And this right here was the bottom of the great financial crisis. Now, what's so cool about looking for follow-through days is you can look at any correction that the markets went through or any bear market, and no resumption of a bull market or new bull market has ever started without a follow-through day. However, it's good to know that it doesn't mean that when we get a follow-through day that has to be the bottom. It just so happens 100% of the time we do see that coming out, so we need to be aware of it and then get a little bit more tactical, and that's what I plan on doing. So if we zoom into the 2008 great financial crisis, over here was November of 2008 to December, and I'm going to show you this wasn't actually the bottom, but we did get follow-through days, so you can see what this looked like, right? We had day 1 of the attempted rally over here, and it happened to be the low as well. Day 2, day 3, day 4, day 5, day 6, and then all of a sudden, day 7 and day 8, we got back-to-back follow-through days right then and there, which tells you, hey, now we can start looking to add some exposure back into these markets. Now, what do you notice here? The market went up, it went choppy, right? We were still volatile. And then we started to actually breach underneath these follow-through days. And this right here is actually more of a warning sign. If you start to break under the follow-through days, you should be a little bit more cautious. Well, you can see we started to break from it, we bounced, and then boom, we had our final flush. Now, this was the bottom of the 2008 financial crisis. So you had over here an up day and also the low. So we're gonna go ahead and call that attempted day one of the attempted rally, day two, day three, day four, and boom, on day 5, we had ourselves a follow-through day. As you can see, more volume than the trading day prior. And on top of that, it was up over 1.25% or higher. And from that point, if we just zoom out even further, we actually never breached that follow-through day and we found ourselves coming out of the great financial crisis. Now, I'm using this as an example. I have other videos where I've showed multiple examples, including the most recent 10% correction that we had. So I'm just using this as an example, but please feel free to do this and go through any correction and look to try to calculate and find these follow-through days. Okay, so once again, this is day 2. Now we got another day or so to go. And day 4 through 7, we're going to start looking, as long as this low is not breached, we're going to start looking for those follow-through days. Now, that's one piece of the puzzle. Okay, we're going to get into market conditions and expected moves, but before we do, I want to hop into some of these signal charts. And you can see that, hey, we were pretty oversold on these bullish percent charts. We saw the bullish divergences that were forming, and guess what? We're getting some relief overall. So is this telling us that, hey, the bottom's in or a bottom's in? Are we going to just bounce up? Boom. We're going to come back down and it just kind of alleviate some of this oversold pressure. The financials as well, right? Bullish divergence today and the prior trading day. Boom. We're starting to see a little bit of a bounce in financials. So you can see from a shorter term perspective, it's pretty much good to know when these divergences build out. You can see the bullish percent chart for technology sector. We've had a couple of days up here working off some of these oversold conditions. This thing got a really low reading, and bam, we started to take back off up to and around that 35% marker. Bullish percent index for the S&P 500, bullish divergence as well. We had a higher low in the RSI, a lower low reading over here, and guess what? We're getting some relief. But does that mean anything, right? Oh, there'll come a time where we come back to overbought, but right now we're just getting a little bit of relief working off some of these divergences. You can see discretionary. This sector is not getting any love. So even today, right? Tesla was down 4 to 5% or even more intraday, and it's down a little bit in the aftermarket session. So there's been getting a lot of heat there. So we need to see Tesla really kind of help out this consumer discretionary to get us out of this oversold condition and maybe see a little bit of relief here in the bullish percent index chart. If we take a look at the NASDAQ McClellan oscillator, you can see that we started to get a black bar over here, getting back above 0. We still on the summation index are below the parabolic SAR. You can see the last time that we happened to tick over, it identified a potential change in trend, which ended up leading us to the downside, but we do have it curling back around. So that's a positive sign at this current moment for the market. If we take a look at the old fool indicator, the TOF, this is where we measure and map the NASDAQ composite divided into the CBOE put to call ratio. It gives us this purple line there in the background. So we got to smooth the data out with some of these EMAs, a 21 and a 50. When the 21 is below the 50 and they cross over, it's known to be a sell signal. So when this was happening, we started talking about it and we let everyone know that it was a lagging indicator, still is a lagging indicator. So we crossed over here. We've seen some continued sell side, and I've highlighted the times that we've seen green for buy signals, red for sell signals, and there's been some whipsaws in between there that I just didn't bother with, but you can kind of see like, hey, we got a sell signal and went down a little bit further. Then we had a quick buy signal. It popped up and went down. Then so you can go in there if you want to look at it. But I wanted to just show this sell signal over here in the last market correction that we kind of went through. Other than August, you can see here, we went down a little bit further, but then we had a nice reflexive bounce, still remained with a sell signal. Then we reverted down. Then we saw another bounce. We came back down. It wasn't until way later where we started to see the buy signal come in, and that led us to a nice market rally higher. And where do we stand right now? Well, as it stands right now, we are on a current sell signal, which means what? It doesn't mean that we can't rally all the way back up to 19,000 or even higher. Who knows? And this thing can turn over positive. But if we do, and this thing remains to be kind of in this downtrend, just be aware of the times that this has happened before and it wasn't all too great. Okay, let's hop into the market conditions. Now, a lot of people have been asking me, so I wanted to share this. Where do you get your gamma levels? How do you get your flip line? And this by far is the most bang for the buck product that I know of, and that's called Gamma Lab. So you can go to gammalab.io. I'll put the link in the pinned comment. It's $14.99 a month, and you can get half off of your first month with their promo code MSD50. Okay, and you can build out your kind of dashboard, which whatever charts you want. You can use like 3 charts up here, so you can have like the 0 dates or 2 dates, SPX or SPY over here, or Qs over here, and then the net gamma, whatever you want to do. And it even has this live news feed. So people have been asking me, there you go. They've given everybody that subscribes to me a 50% off your first month. So it's like $8 for an entire month. I use this all the time. Okay, this is one of the charts actually that I wanted to share from their service, and that is CTA positioning. And you can see that this is just massive, massive short position. CTAs, they're commodity trading advisors, their momentum, they're following the momentum, as we've stated on the earlier part of this episode, right? We've just seen our number 5 fastest 10% correction in the last 75 years. And what do you think is really propelling this stuff? Well, CTAs could be one element to this, and they're massively short position, right? So minus 34, which is in the billions. So what can happen if they start to cover and we start getting above some key levels? Well, they can actually ignite a rally to the upside in these markets. Now, they're not doing so yet, but that might be something to really pay attention to and be aware of in the current positioning here with CTAs. You can even look at vol control positioning, and you can see that they have been a big influence on selling pressure as well. Now, if we take a look at the VIX futures curve, guess what? We're not in backwardation at the moment, so we started to move back into contango. This is a positive sign in the market. You can see here, we've been underneath this 1.0 when we measure back month versus front month volatility. As soon as we started clipping under it, we said this is pretty much where we can start to find a bottom or base out and take a look. Guess what? We went down a little bit more, but now we're bouncing up a little bit, getting out from these oversold conditions, and boom, it really does help to know this. I get that when you're in it, right, and it's selling off on a day, and you're like, oh no, maybe this time is different. Well, it's not, right? We're starting to bounce up, and if we come back up here, we'll know that, hey, things are getting a little frothy once again, but to the upside. So right now, yeah, we're getting a little bit of a reprieve in this sell side action. Now, when you look at this 2-hour chart of the SPX and we have some of these gamma levels, I mean, what do you notice, right? You barely notice this bounce. It's been kind of like a gap run up, and then we kind of rallied into this 5,700, which happened to be a very important 0-date level today and a net gamma level, and we kind of rejected from there pretty much as soon as we came into that. Now, one of the conditions that I look for is that flip line. That flip line is, I'm going to just call it 5,800 for right now because that's basically where it's at. So if we start moving up into here, this is also net gamma area. Be aware of 5,800 like we were aware of 5,700 today, because you can get price action, right? It can come above it, but if there aren't traders reaching out further, right? If there aren't levels reaching out further, you can come back in pretty fast and kind of get pinned around and or rejected from those specific levels. So right now, negative gamma, which means, once again, selling begets selling, buying begets buying, volatility typically increases, but we're getting back out of that liquidation, right? We're fixing this chart here a little bit too, which is helping overall with volatility coming in from that pesky little 30% level that we called out on a few videos ago. If you look at net gamma, the call wall is up here at about 6,000, but I just wanted to call out the 5,700, which we're basically at right now, right? There's not much above that or going on, but we do have a lot of levels beneath us. So if we do all of a sudden break lower, just pay attention to these round levels here, like 5,500, 5,600 to see how they grow. This right here is 5,650. Okay. So we want to get above 5,700 and start breaking up to the upside, and then we can start looking for levels back above us. We've been in negative gamma here for quite some time, 15 to 16 trading days. That's what I have highlighted on this chart over here. We've been in negative gamma, and as soon as we get into negative gamma, I like to highlight them with gray boxes, because if you look back through history, you can see that this is a great early indication that those market conditions can very well change and volatility can pick up. And I think that's a huge advantage, knowing that before anything big potentially take place. And you can see, right? Boom, we saw a big move up, but we knew about it. since day one of falling under and staying under that gamma flip line. The next thing I like to look at here in market conditions is that direction of the 5-day moving average. This is something that I learned from Brian Shannon. I even liked his chart, so I went ahead and built the indicator myself so I can easily display it in its kind of cool colors. And you can see here, we started turning yellow, which basically means, hey, we're still going up, right? The direction of the 5-day moving average is up, but we're prices below it. So it gives us a warning sign. And you can see we broke down, we doodled around that blue line, which is the year-to-date volume weighted average price. And since that point, really, it told us, hey, we're in negative gamma, we're below a declining 5-day moving average, watch out until things get better. Well, we had a series of lower highs and lower lows. Up until recently, this last video, we called out semiconductors actually put in a higher low while S&P 500 was down and Qs was down too. So that was a positive sign that we may get some sort of follow through. And now, a couple trading days later, guess what? Well, we're starting to see green here once again. So we got the SPYs starting to change that direction of the 5-day moving average. The Qs, the IWM, right? DIA is currently yellow, but I mean, we stay up here for a few more candles. It's back to green to flattening out. Now, this is still the early stages. So what I would like to see is a pullback or follow through, whichever way, and then see how it digests as it actually starts to gather some ground and potentially then get us outside of this negative gamma regime. So that is kind of what I'd be looking for. And then I'll give you some of these expected moves too as well. So last week, we ended up closing back inside the expected move, right? Each week this year, right? This is the first, well, not the full first trading week of the year, but this traded into 2025. And every single week, we have tagged and or exceeded expected moves. So we've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 trading weeks so far. We're working on 12, okay, trading weeks so far. And out of those 12, we had 1, 2, 3, 4, 5 of those 12 close outside of it. So almost 50% right now closing outside of the weekly expected move. So that tells me, and that should tell you, that the market hasn't been really too efficient in handicapping risk. However, on the flip side of this, it is tagged 100% of the times its expected moves for the week. And as you can see, we've recently been just increasing these expected moves from 7 to 11 to 12 to 15, right? So we're in that period of expansion, and now, boom, we're starting to contract ever so slightly. It's still the second largest of the year, so be aware. Volatility is still here. We closed once again inside last week's, and today we had some follow through to the upside to be slightly positive from a weekly perspective, and we came back in to and around what the month was priced in for its expected move. Now, we still have trading time left, so if we start to break up into these areas, right, it'd be normal to see some sort of a consolidation, see how it sets up, and potentially turn into something more, or turn into a dead cat bounce. So we got to monitor that as we continue. Now, today's daily expected moves, these were these red zones and green zones. Look how perfect it came up to it today. And then we started rejecting back down. Took a look at the Qs. It came right up to it. We started pressing back down. So I'm going to update you on today's levels going into tomorrow. So here is the SPY, and I have a couple extra levels here. Okay, this is the daily implied range for tomorrow, the upper and the lower levels. We got about 5. I'm going to go from the lower one and the upper one, but these ones are pulled from the options chain over here. So about 560-ish to about 574 and some change. You can get the exact levels, screenshot them, and put them on your chart if you would like. Okay, now from a positive perspective, what I like to see is that direction of the 5-day moving average start to curl over. Now this white line, okay, I'm going to go over a couple of lines here. This white line is last week's week-to-date anchored volume average price. And the reason why I find this one to be important to hold is because Monday was an absolute bloodbath in the markets. It was a very, very big, powerful volume day to the downside. And as you can see, we held that multiple times throughout the week, getting rejected. It wasn't up until March 14th over here that we started to get back above it and hold it. So right now, this is going to be a very interesting level of confluence to hold. This red line is the low as it stands, VWAP from the correction low. So you can see all of this here is in confluence. We have the daily implied zone, we have the 5-day moving average, last week's anchored volume weighted average price, and the swing low of this correction. So if we were to come down into these areas, still, right, if we can hold above this stuff, and even if we undercut and come back up, this could be a good buy the dip opportunity if this trend is actually going to change and move higher. Now, we might not come down here tomorrow, I don't know, but that would be what I'd be looking for if we are. And if we do slip way off here, and then all of a sudden we're flat on the week again, that could scare a lot of people. But for the people that understand that, hey, we have some confluence down here, this is what the market was priced in, this is completely normal, we're getting back above this, this is kind of normal behavior in the realms of volatility to see something potentially press back up. So from a bullish perspective, that's what I'd be looking for. If we undercut this or gap under this and then starts breaking down, yeah, like watch out. Look for strength after that would have taken place or potentially takes place. Other than that, if we start obviously breaking above the high, right, of today's trading session, that could be a key level to watch. And you can see if I actually take this high and just kind of move it across the screen over here, it's pretty similar to where we had the start of Monday's high. So if we can actually come in, consolidate, and then eventually break through that, we can start to look at the upper weekly implied move and as gap fill. The gap fill is actually more like down here. This is the gap over here from that Monday's gap down session. And sometimes if you come up there, you can find potential resistance. Now, another talk on this, if we start moving through and up to the weekly implied move, I want you to pay attention to this green line. This green line is the VWAP from the all-time high. So if we come up there in a fury, right, we most likely in this type of confluence where you have the upper weekly EM, this right here, right, there's a strong possibility that you can get rejected from the level and potentially start to consolidate out and have these averages start to turn back up and see how it sets up after that point. But as it stands right now, from the correction low, from the all-time high, we're closing in, right? These are two are contracting. So you want to hold above this, you want to consolidate and get tight right up and around this VWAP from up here and eventually break it to the upside. That's what a very ideal positive look would be. And as we do that, the 5-day moving average would start to turn around too. So that would be a very good look for this consolidation. Perhaps that breakout gives us that follow through day that we are going to be watching for. And then we have the Qs over here. You can see we have the daily implied zone beneath us. It's about 475-ish to above us, about 490 and some change. If you want the exact levels, just screenshot and mark them on your chart. We're holding above the VWAP from the correction low. We're below the all-time high VWAP. You can see we tagged into the quarterly expected move, basically to the penny, and we've bounced from that specific level right now. We have our weekly implied moves, right, for this week as well. And the same story goes. I'd be looking, if it comes down into these areas, pay attention to these VWAPs. And if we can hold within this confluence and start to bounce from it, right, it's very likely to come back down in here because that's the month-to-date EM. Look at, we broke through it right here. We came back, it acted as resistance. We came back to it. It's been doodling around. The market priced this level in at the beginning, at the end of actually the prior month. So we're kind of just doodling around, but we're holding some key levels. So far, this is positive. We got a couple more days to go, right? One more trading day left, and then we start to look for these follow-through days. As long as we can kind of hold these lows and some of these levels of confluence, that is kind of what I want to pay attention to feel more confident about adding back more exposure, maybe getting some more trade ideas out there too as well. Hope that helps out, and I'll see you on the next.